The initial paragraph on this slide is a formal definition of revenue from FASB's conceptual framework. Take a minute and read through it. I hope you recognize in all those words the simpler version of our revenue definition that we've used in previous units. Revenue is the inflow of cash or other assets, and sometimes the settlement of liabilities, but it's generally the inflow of assets in exchange for providing goods or services to your customers. Correct revenue recognition is one of the most critical aspects of financial reporting. After all, revenue is oftentimes the single largest number reported in the financial statements. Historically, the proper reporting of revenue has been one of the most contentious issues that companies face with the Securities and Exchange Commission. We'll stick to some fairly simple and basic situations, but in life, revenue recognition can get to be very, very complicated. Companies need to not only be able to determine the proper amount of revenue to recognize, but they have to get that timing correct. They have to record their revenue in the correct financial statement period. What you're looking at here is a pretty new revenue recognition principle. The U.S. Accounting Standards Board, FASB, and the International Accounting Standards Board worked together for many, many years to come up with a converged standard. They were finally successful in issuing that standard in 2014. However, here in the U.S., the standard didn't actually go into effect for companies whose stock is publicly traded until after the end of 2017. For many transactions, the new revenue recognition principle doesn't change the timing or the amount of revenue recognition compared to the standard that was in effect for many, many decades. However, that's certainly not the case for all companies or all industries. The standard's actually really important. It provides a unified approach for revenue recognition that replaces more than 200 different pieces of specialized guidance that had developed over time here in the U.S. Our standards in the U.S. had lots of special revenue recognition rules for various industries and in various circumstances. This new standard is supposed to provide a theoretical framework to get to the correct revenue recognition for all companies. As you can see, the principle basically states that companies will recognize revenue when they provide goods or services to their customers, and the amount of revenue that they recognize is the amount they are entitled to receive from their customers. Let's walk through the 5 key steps that we use to apply the revenue recognition principle. All revenue recognition starts with a contract between a seller and a customer. Those contracts contain one or more performance obligations. Performance obligations are promises by the seller to transfer goods or services to a customer. If a company agrees to sell an appliance to a customer, then that agreement is a performance obligation. If a company offers to sell an appliance to a customer and also sells them an extended warranty on that appliance, then the company has 2 performance obligations that it is responsible for. The next step is to determine the transaction price, and that's usually fairly easy to determine from the contract. When there's multiple performance obligations involved in a contract, step 4 says that a company needs to allocate the overall transaction price in that contract between the performance obligations. Then finally, in step 5 here, the company recognizes revenue as each performance obligation is satisfied. In general, the seller recognizes revenue when it satisfies a performance obligation by transferring the promised good or service. We consider transfer to have occurred when the customer has control of the good or the service. Control means that the customer has direct influence over the use of the good or service, and the customer is obtaining the benefits of that good or service. For many contracts, following this approach is very straightforward. In particular, if a contract only includes one performance obligation, we typically just have to decide when the seller delivers the goods or provides the service to the customer, and then make sure that the seller recognizes revenue at that time. On this slide, you can see some of the key indicators that are used to determine when control has transferred from the seller to the customer. Sellers need to evaluate these indicators individually and in combination to decide whether control has been transferred, because that's what determines whether or not revenue can be recognized. As we saw in the previous slide, the most common situation is that a company satisfies a performance obligation at a specific time, and we recognize the revenue at that point in time as well. However, there are situations where companies need to record their revenue over a period of time. There's 3 different situations that can create that. They're on the list below here. The first one here would be by far the most common situation. This is when the customer is consuming the benefit of the seller's work as it's performed. The example here is a cleaning service, so picture a cleaning service that creates annual contracts with its customers. It would not make any sense for the cleaning service to need to wait until all 12 months worth of services had been provided. Instead, they're going to record their revenue little by little over time. The second situation is one where the customer is able to control the asset as it gets created. So an example of that might be something like you're having a business is having an addition put on to an existing building. The third situation here is where the seller is creating an asset that's really customized, and so it's creating this asset that will have no alternative use to the seller, and the seller has a right to receive payments for progress to date even if that contract gets canceled. These last 2 conditions are perhaps less common than the first one, but these are actually conditions that oftentimes exist in long-term construction contracts, and so oftentimes revenue from long-term construction contracts is recorded over the construction period itself. Well, when any one of those 3 conditions is satisfied, revenue gets recognized in proportion to the amount of the performance obligation that's been satisfied. If none of those 3 conditions exist, then revenue won't be recorded until the performance obligation is completely satisfied, so at the end of the contract. As we said, when revenue is recognized over time, companies are going to have to estimate their progress towards completion of the performance obligation. The estimate can be done based on input methods or output methods. An output-based estimate of progress measures the proportion of the goods or services transferred to date. Examples could include things like number of miles of road that have been built, tons of coal delivered, or days of interest earned. The other option here are input-based estimates of progress towards completion of a performance obligation. These input-based estimates measure the proportion of effort expended so far relative to the total effort expected to be expended in order to satisfy the performance obligation. A common input-based method is called the cost-to-cost ratio. The cost-to-cost ratio compares the cost incurred to date to the estimated total cost expected to be incurred, generally in a long-term construction contract. Earlier, I mentioned that many contracts could contain multiple performance obligations. When that's the case, step 2 and 4 of the revenue recognition process need special attention. Companies need to be sure they've properly identified all of the separate performance obligations, and then they need to be able to allocate the contract transaction price to each one of those performance obligations. Let's take a look at this example. We have Toro Company that sells software. They sold software to a customer on July 1st of year 8 for $8,000. In that customer's contract, it said that the customer was also getting 12 months worth of free technical support. So the customer is receiving software and 12 months worth of technical support. We also have some information about the software and how they normally sell it, and the fact that they also sell that 12-month technical support on a standalone basis. When they sell just the software, they sell it for $7,500, and when they sell just the support agreement, it's sold for $2,500. The question we're asking here is, how much revenue should Toro report in their income statement for the year ended 12/31 of year 8? Well, going through our steps, the first thing that Toro would do is identify if they did have a contract, and they certainly do here. The next thing they would need to do is read through that contract and determine how many performance obligations are involved. Well, in this case, as you can see off to the right here, there is 2 performance obligations in that contract. Toro has promised to provide the software to the customer, and they've also committed to provide the 12 months worth of support revenue. So we have 2 different performance obligations. The software revenue should be recorded at the date of sale when Toro transfers that software to the customer. The support revenue is one of those situations where the revenue will be recorded over time. There's 12 months worth of technical support. The customer is getting the benefit of that on a monthly basis, so that support revenue will be recognized pro rata over the 12 months beginning July 1st of year 8. So that's when we should be recording the revenue. The next question that we have to answer here is, how much revenue should be recorded for the software, and how much revenue should be recorded for the 12-month technical support agreement. Well, the revenue is allocated to the performance obligations pro rata to the value of those performance obligations. In this case, we're fortunate because Toro sells the software and the support agreement separately, so we have a readily available fair value for those items. We're going to take the $7,500, that's the normal standalone selling price for the software, and divide it by the total value of the software and the support agreement. So the denominator here is the $7,500 for the software plus the $2,500 for the support agreement. So the software is 75% of the total fair value, and what that means is we're going to allocate 75% of the contract price to the software, or $6,000. We do the same thing, of course, for the technical support agreement. The technical support agreement is 25% of the total value of the contract, so $2,000 of the sales revenue gets allocated to the support agreement performance obligation. All of the software revenue will be recognized in year 8, and 6 out of 12 months worth of the support agreement revenue will be recognized in year 8, or $1,000. So the total revenue from this contract that gets recorded in year 8 is $7,000, the $6,000 plus the $1,000. The other $1,000 of this support agreement would be on the balance sheet as unearned revenue, a liability account. Well, what you've just heard is a fairly brief overview of the basics of revenue recognition. There are, of course, many complications in this area. Some of the complications are actually discussed briefly in your textbook. You'll see a section that includes things like consignment sales, licenses, variable consideration, and a few other items. In addition, your textbook gives some examples. They're fairly simple examples, but they give you some examples to give you an understanding of how the accounting works for long-term construction contracts. Even though those discussions are brief, they should be sufficient to give you an understanding of these basic areas.